This week in economics on the 15th of September 2018. This is a weekly program that we jointly host here from WBRN Radio on the Bostonred Network and Cranston Analytics, looking at the macro situation. We'll start with the sales numbers for August of 2018. And we'll dive a little deeper into the numbers and most of the news reports that are given. First of all, there is some decrease here. We're looking at August. Let's look at July. July was revised to 7/10 at $508.6 billion. And in August, it was just 1/10% at $509 billion. That was $508 billion.6 there. And the next release is in October. The advanced estimate of retail and food service sales for August, adjusted for seasonal variations, holidays, and trading differences, but not for price change, was $509 billion, an increase of 1/10 there from the previous month, and 6.6% above the August of 2017. Total sales for June through August period were up 6.5% from the same period 1 year ago. The June 2018 to July 2018 percentage change was revised up 0.5%, and up to 0.7%. Their retail sales were up 0.1% from July of 2018, and 6.2% above last year. Gasoline stations were up 20.3% from August of 2017, while non-store retailers were up 10.4% from last year. The general information here, and we'll get down to the explanation of what was going on. The Census Bureau conducts advanced monthly retail, trade, and food service surveys to provide an estimate of monthly sales by kind of business for retail and food services located in the U.S. Each month's questionnaire are mailed to a probability sample of approximately 5,500 employees from firms selected from a larger monthly retail trade survey. The advanced sales estimate are computed using a link relative estimator for each detailed industry. We compute a ratio of current to previous month weighted sales using data from units which we've obtained usable response from both current and previous months. So this is some of what is going on here, and we will append this, so I won't really go into it, but what we will do is now receiving additional updates on key economic indicators by downloading the free application for Android and Apple devices. This is the signature database of the Federal Reserve of St. Louis, now incorporated in the Census Bureau. We get the latest information from them, but you can put this on your device. Now, the estimated monthly sales for retail and food services by the kind of business. This is an 8-month total 2018. And this is the total excluding motor vehicles and parts. The total here, 3,954,000. 923. The change here, this is for 8-month total, 5.7%. For August, it was 523,743. Now we do with the gasoline stations, as they call them, 3,127,000.43. That is a change of in 8 months, 6.3. As motor vehicles parts, sorry about that. Now the gas stations, the change was 4.9 here, and total motor vehicles and parts and gas stations here was a 5.2 change there. And we get down to motor vehicle and parts dealers, 3.7 change there. New car dealers, they've added it all evidently together here at 766,243. Furniture and home furniture stores at at 78,793. In electronic appliance stores at 61,217. It's a 2.7 change there, and 5 the furniture home appliance dealers. Now, this was for August. At 8,149, and the percentage of changes here 28143. Down to building materials, garden supplies dealers at 262,053. The change there was 3.9. It was in August. Food and beverage stores, 4.1 was a change, 489,869. Grocery stores, 4% change there, and beer, wine stores, just an asterisk there. Personal care, wait a minute here. Health and personal care stores at 4.4 change there. 227,801. Gasoline stations, a 15.6 change there. You can see the prices going up there for clothing and clothing accessories, 5.7. Sporting goods, hobby, musical instruments, and bookstores, a negative 2.2 there. General merchandise, 3.7. Department stores, 0.2 tenths in the negative there for them. And miscellaneous types, 4.9%. Non-store retailers, I'm not sure what a non-store retailer is, but nonetheless at 10.1. Food, service, and drinking places at 6.2. Estimated change in monthly sales for retail and food by a kind of business. The total was 1/10 for July and 2018. That's from the advance, and it was in 2017 6.6. Some of the changes taking place here: motor vehicles parts dealers a negative 0.8 tenths. That was in July of 2018. And clothing stores, negative 1.7. Sporting goods, 0.2. General merchandise, 0.1. And so forth here. Food service and drinking places, 0.2 there. So you can see that things are, these various categories are, in fact, going downward. Let me just go to a formal here from, this is from the Reuters people. The 0.2% in August, the smallest increase since February, 6 months. Modest increase suggests that higher gasoline and petrol prices could be pulling away the categories there. Retail, the smallest gain in 6 months. This is from Reuters. Other data showed that the biggest drop in import prices in more than 1.5 years. In August, a decline in the cost of fuel and a range of other goods. The weak import price data came on the heels of the soft inflation reading from the Department of Commerce. Retail sales edged up 0.1. Retail sales in August advanced 6.6 from last year. But this year is not basically last year. Core retail sales were previously reported to increase 0.5% in July, despite the slowdown in core retail sales in August. Consumer spending remained supported by the tightening labor market, which is steadily pushing up wages. Annual wage growth is its fastest pace in more than 9 years. In August, there was a record 6.9 million job openings in July. Spending is being underpinned by tax cuts and huge savings. Weak auto sales. The economy is poised for strong growth in Q3 this year, but an escalating trade war, of course, will dampen various things. The economy grew. That was in April to June at 4.2%. The fastest growth in 4 years, almost double the 2.2% pace in the first quarter. Growth estimates for the third quarter topped the 3% rate. 3% is very, very hard to maintain. Auto sales fell 0.8% in August after slipping 0.1% in July. Receipts at service stations surged 1.7%, likely, of course, reflecting that, which has risen 32%, 32 cents this per gallon this year. So we expect that to go up, given some of the situations that are going on. Sales at clothing stores, of course, fell, and those have been falling for quite some time. 1.7%, the biggest drop since February of 2017, after accelerating 2.2% in July. Receipts at furniture stores, 0.3%, and sales at building material stores were unchanged. There was an increase online in mail order retail sales. Americans also spent a bit more at restaurants, and we went over that. Separate report, import prices fell 0.6% in August, the largest decline since January of 2017, after slipping 0.1% in July. Drops in import prices likely reflected a strong dollar, which has gained more than 6% this year against a basket of currencies. In the 12 months through August, import prices rose 3.7% after surging 4.9% in July. Prices for imports from China slipped 1%. In August, a second straight month, prices for Chinese imports gained 0.2% in 12 months. There, so this is part of what is going on here. Let's see. We'll go to the Independent Business Daily here. Retail sales increased at slowest. Now, this was in June, so things have changed, no doubt about that. Online sales, these are some of the more dated articles here, but let's go back to Bloomberg talking on in, obviously, the trade war with China. There's no doubt about that. That will continue on. Period. And we'll just take a look at it. This is on September the 13th from Bloomberg. The trade war is following an increased predictable pattern and should cause a rethinking for anyone hoping for a rapid resolution. The day after the financial markets around the world cheered the apparent good news from the U.S. Treasury Secretary was inviting his Chinese counterparts to set down high-level negotiations. We are under no pressure to make a deal with China. They are under pressure to make a deal with us. That was a mistake. That was from DJ Trump. He followed up Thursday just hours after a tweet by instructing aides in a meeting to proceed with plans for new $200 billion in tariffs on Chinese products. The move marked the latest instance of Trump undercutting one of his senior China deal makers in public and illustrating why Beijing has become increasingly frustrated with the interaction with the administration. Ross and his team, however, were quickly criticized for being too abstentious to China, essentially after he hailed a heated schedule of commitments by Beijing as Herculean. Anyway, there's certain openings to overtures because they're likely to bring the trade dispute to some type of resolution, but I don't think they're going to give anything to Muncham. That is from Esau Passé, a former Chinese division chief at the International Monetary Fund. And that's the whole thing. This whole bargaining interplay between the Trump administration and the Chinese government is based upon some American type models that if you put on enough sanctions, the Chinese government will surrender. That is not happening. Their models have already predicted what will occur. So a long and intensified trade war, Chinese officials have begun to contemplate the possibility of a new Cold War with the U.S. dollar, which is how hawkish the hawks in the Trump administration, such as Leitzinger and Navarro, see it as well, arguing for tariffs as just one tool to engineer a long-term decoupling of the world's two largest economies. With those dynamics in mind, Chinese policymakers are beginning to realize that any solution to growing trade problems with the U.S. may be, in the end, depending on them negotiating a peace directly with the hawks. But the hawks in the administration are convinced that the essential battle with China and the likely to demand deep and long-term changes from Beijing that is likely to resist such negotiations will be difficult, and no doubt about that. And they'll be difficult in the sense that they will not go to any type of fruition. That is the biggest problem that is being faced by the negotiators. So in other words, there is basically nothing going to happen here. It's just one of those situations that simply just will not occur. I was just looking at the Business Daily here with cars, and we'll move on to the job situation. Interesting. Car companies are pouring billions into self-driving tech they may never use experts are spending billions on self-driving technologies, but even if they have to buy autonomous systems from other companies, their investment may not be wasted there. So you've heard a lot about this. In the age of self-driving vehicles, approach the automobile industry, or the auto industry as they put it here, may be facing the most significant transformation in its history. Once cars are able to drive themselves, the relationships between car companies and consumers will change, and vehicles will be just one piece in a large network of services rather than on the all-purpose transportation solution. This means traditional automobile companies have to make one or two difficult choices they plan for the future. That's according to Matt Torster, Managing Director of Hardware and Forensic Technology at Silicon Valley Bank. They'll either continue to focus on vehicle manufacturing or accept the fact that an increasing percentage of the automobile profits will be taken by companies that own self-driving technologies. In a 2017 study, Intel and Strategic Analytics projects that the global market for autonomous driving vehicles will be $7 trillion in 2050, while automobiles are makers are spending billions of dollars acquiring autonomous driving startups and developing services that may overcome traditional vehicle ownerships in the coming decades. But the automobile industry traditional giants aren't alone. They face significant competition from startups like Aurora, Xerox, and major tech companies like Waymo, Uber, and Apple. The automobile makers, this is our little futuristic story here. That's a good segue as they battle for future automobile industry heats up. One big question is yet to be answered. Will multiple self-driving systems be able to coexist, or will every automobile maker be forced to buy the best available self-driving technology? You might be able to get away with having batteries whose average is 15% worse than the competition, but will the same be true for a self-driving system that is 15% more likely to come confused at a stoplight and avoid accidents? One of the very big problems coming up here. And one self-driving system won't be enough. That's a Navigate research. And what you're seeing happening here is a number of these companies, including our Crash Analytics, is working on this. There are thousands of them out there, and many of them have just started up in the past 1 or 2 years. Period. It's unlikely auto companies will use just one self-driving system for their vehicles. Instead, it will be wiser to use two different redundant systems that could confirm what the other one sees or keeps the vehicle if the other breaks down. So Tesla, you heard a lot about Tesla in the news, and we can look at Tesla from because of its large share from a macro standpoint. Innovation in self-driving autonomous driver assistance in the future. Tesla may have a problem when it comes to full autonomy. It's according to I won't try to pronounce this, who says the company is behind competitors like GM or Waymo, Daimler, Chrysler, Ford, and so forth. Well, Tesla says the hardware in this vehicle will one day be able to support full autonomy. The company's approach to self-driving technology is too reliant on cameras and doesn't have enough redundancy in its sensors or computer platform. Well, Tesla is one of the first in the game, and many times being first in the game is not where we want to go. Tesla has been aggressive in its efforts to maximize control over design, manufacturing, sale, and service process for its vehicles. That strategy has paid off. In some years, the company has received praise for its battery engineering, electric motors, and backfired in others. And you can start to see as the industry matures, and this is not unusual, the price for some things will go down. Let's look at the employment situation here. We've been kind of setting this on the back burner. Let me just... Okay. This is a quarterly census of employment and wages here. And let me see if I can get to it. This is from the Bureau of Labor Statistics, where we normally land. And let me just see. We return. This is the real earnings, August of 2018. It was released on September the 13th. Real average hourly earnings for all of workers increased 1/10% from July to August, seasonally adjusted. This is from the Bureau of Labor Statistics. The results stem from a 0.4% increase in hourly earnings combined with a 0.2% increase in the consumer price index for urban consumers. The real hourly earning increased 0.2% seasonally adjusted from August 2017 to August 2018. The change in real hourly earnings combined with a 0.3% increase in the average work week, resulted in a 0.5% increase in real hourly earnings over the period. Real hourly earnings for the production and non-supervisory workers was unchanged in July to August. From August 2017 to August 2018, real hourly earnings decreased 0.1% seasonally adjusted, combining the change in average hourly earnings of 0.6% increase in real work week resulted in a 0.5% increase in the average work week. Now let's dig a little deeper into this. This is the current and real dollar earnings for all workers on private non-farm payrolls. I'm having trouble even saying it. The real average hourly earning at $10.76. That was in August, of 2017, and it's $10.78 in August of 2018. Real weekly earnings in August of 2017, $370.14. It was $372.06. The consumer price index for all $245.262, and in August it was $251.846. Let me get that right there. And the average hourly earning was $26.39. That was in August of last year. In August of this year, it's $27.16. Now, differentiating this from the real average hourly wage. So, real average hourly earning was a negative 0.2. That was in August of 2017. It's 1/10 of this August. And if we go to average weekly earnings, it was 0.2 in August of last year and 0.4 this year. We'll append this chart because it is important. Current and real dollar earnings from 1982, 1984 dollars. Now, a little different here. If we looked at last year, August of last year, 2017, be $9.25, and this year it would be $9.24. That's the real average hourly. And the average hourly earning would be last year at $20.11. That's using $82, $84, and $22.73 this year. The average weekly hours at 33.6, that would be last year, and 33.8 this year. And the weekly earnings here, $742.90. That was last year, and this year would be $768.27. So you can look at these charts and tell. Now, the earnings series presented in this release are derived from the Bureau of Labor Statistics Employment Statistics Survey. That is the monthly survey of employment, etc., and the Consumer Price Index for all urban consumers. So it tells you a little bit about the methodology that they used. We'll let you look at all this. The annual earnings average can be different significantly from the results obtained by multiple average weekly earnings times 52. So some of the things here are a little different, but this is constant $82, $84 earnings for production non-supervisory types. Kind of interesting here that be $9.25, $9.24, actually a penny less that you would have been making in 1982, 85, when you're basically doing what, $22.11, $22.73. So it does put one there in terms of what the average hourly earning for workers increased 1/10%. There, that stems from a 0.4% average hour earning, combined with a 0.2% increase in the Consumer Price Index. Very, very interesting in its essence. Now, this is from the National Association of Manufacturers. This is the outlook here, something that we had earlier in the week, and I suppose we'll read the survey here, or at least part of it. Percentage of respondents positive about their own company's outlook, 95.1, all-time high according to this, and this is from the Association of Manufacturers. The Manufacturing Outlook Index at 63.8. Summary, oops, let me get the summarization here. This is from the National Association of Manufacturers. It's clear that businesses continue to experience high levels of activity as a result of pro-growth policies like tax reform, optimism, and once again, a breaking record. 95.1% of respondents were either somewhat or very positive about their own company's outlook. This is the highest since the 20-year survey introduced in the fourth quarter of 1997. In general, these competing surveys have been upbeat since 2016, averaging a 92.6%. And this kind of gives you a little historic record here of where they're going. And this is some of the numbers here. They were at 93.3% in 2017, and in the first quarter. In the second quarter here at 95.1%. In 2016, they were at what? In the third quarter at 61%. In the fourth quarter, they were at 77%. And it started looking up in 2017 for the manufacturers. Many of the tax cuts did, in fact, help them. They talk about business environments no longer concerned that it once was, with just 19.1%, citing a tax and regulatory climate as being a top concern. I imagine it's not anymore since they've got their tax cut. Respondents expect full-time employment to increase by 3.1% over the next 12 months, up from 2.9% in the previous release. More than 66% anticipate more hiring next year, including 27.4% planning employment growth of 5% or more, and just 3.3% see employment falling. Wages, this is, we just went through this. Compensation such as benefits to rise 2.7% over the next 12 months, inching up from 2.6% in the March's survey. 94.2% see wages increasing over the next year, with nearly 47% expecting the hike to be 3% or more. Capital spending to rise of 4.1%. And they expect a sales growth of 5.7% over the next 12 months. That is not as realistic there. And the minimum size, those with 50 to 499 workers. And large size, this is pretty much old standard classification with 500 or more. Manufacturers expect sales growth at 5.8%. A lot of this will depend on the tariff regime and what they produce. Raw material prices, anticipate raw material prices and other input costs rising 5.6% over the next 12 months, with 55% of respondents seeing prices grow at a 5% rate. Exports, international demand remains strong on imported global growth. Respondents expect sales to rise by 1.5% over the next 12 months, up from 1.2% in March. I suppose that's fairly realistic given all the various trade wars out here. Primary business challenges, attracting and retaining workforce, 76.7%. Raw materials costs for our products, 72.2%. Rising healthcare costs at 65.3%. And the unfavorable business climate is down to 19.1%. Stronger U.S. dollar relative to other countries, 17.4%. You can see there are not any worries there in that particular scenario. Let's move on here to our current regiment. As we moved across here, we had some from Hurricane Florence. Some cost things here. The total bill for damages may reach $18 billion, lower than early estimates. That's according to a disaster researcher in Savannah, Georgia, Inca Research. That includes $15 billion for North Carolina, $2 billion for South Carolina, and $1 billion elsewhere. 134,306 flood insurance policies have been issued in North Carolina for $33.7 billion in property, the vast majority along the coastline. The region's population has been rising, and since 2000, at least 19 counties in North Carolina and South Carolina have seen more than 25,000 residential units built, part of the problem. State's agricultural economy is also at risk. North Carolina is forecast to harvest 158,800 acres of tobacco this year. It's the nation's top producer. The half the eastern North Carolina crop will basically be destroyed. A sobering note there, more than 60 swine operations house more than 235,000 hogs. that generate staggering amount here, 202 million gallons of waste per year within the floodplain of North Carolina's coast. That's according to Waterkeepers, a watchdog group, and we commend Bloomberg for bringing this in. More than 40,000 utility workers from at least 19 states are ready to restore power, according to a news release from the Feds, from Duke Energy, and various others. Florence is the first major hurricane of the Atlantic season and will test the administration's ability to respond to disasters. That has been a sensitive topic, obviously, since the tissue paper were thrown in Puerto Rico. Well, I won't even get into that. This is ridiculous. Studies have found from George Washington University, from the Harvard study, etc., that over 3,000 people were killed in Puerto Rico. At one time, they had a paltry sum of 16. Just totally ridiculous. Let's see. The president will visit Florence, the area hit by Florence. Anyway, from a livestock broker based in Greenville, North Carolina. After leaving his home early this week to take shelter, we are just playing Noah up here. I'm not sure what that means, but anyway, it is an apocalyptic situation in North Carolina. So in other words, the damage from that, particularly to that region, will be monitored. That will have some effect on the economy. This is, I won't spend a lot of time on it. The global economy is still feeling the Lehman fallout from 10 years later, the collapse of Lehman Brothers and the consequent global financial crisis, the deepest since the Great Depression. In fact, it caused a depression. And we look at a little bit of this. We won't spend a lot of time on this particular part other than to say it is still here. And shows the balance sheets of various ones here, having cut interest rates to almost zero, and in some cases lower. Central banks have, of course, started that out. They have the Federal Reserve, the European Central Bank, and the Bank of Japan. On President's swelling of their balance sheets, no doubt about that. Government debt, for all the talk of austerity, government debt in most parts of the world are larger now than in 2007, no doubt about that. And some figures here. I think I'll go ahead and pinch this for the simple reason that there is a lot of data here. Robust corporate profits have coincided with strong stock market. If there's been a winner in the last 10 years, it's the corporate sector. In the age of easy money, house prices, of course, going up here. At the heart of the crisis, house prices have now recovered in most corners of the world. Populists and authoritarians now oversee a big chunk of G20 output. Voters are hitting back at inequality, frustrated by lack of jobs, low pay, etc. And they point to the election in the UK and in the U.S. Can we survive the next financial crisis? The fourth biggest investment bank, then it was Lehman Brothers, declared bankruptcy. That was on the 15th of September 2008. Banks are safer on many counts than before the crisis. Economic and political repercussions are still being felt. Most important change, banks have sharply increased their capital requirements. Lehman Brothers and other big firms had so little in 2007, about $2 for every $100 in assets. Now it's $7. So there have been some changes here in those capital requirements. But there's also a move in the conservative Congress to lessen some of those requirements. Shrinking banks, regulators have constrained bigger bank growth despite swelling weak rivals at the height of the crisis. J.P. Morgan, Bank of America are smaller than they were in 2007. Some European giants, Royal Bank of Scotland, they both are bailed out by the government at less than a third of their pre-crisis size. China's great banks top the rank. The large firms have been forced to simplify their legal structure. The U.S. lender with most businesses cut the number in half. That's according to a May study by the New York Fed. Living Wills, a blueprint that explains how the biggest institutions can be unwound in a bankruptcy. During the first week of Lehman, bankruptcy creditors in Europe were dismayed to find that all the cash from all the subsidiaries routinely went to the parent in New York at the end of the day. More problems that were not foreseen at the time. And here we go. Let's see what we can find. New norm. The Fed, the first central bank to cut interest rates to almost zero at the end of 2018. Then the European Central Bank and the Bank of England followed suit in 2009. So you have terribly low negative yields, trillions of dollars of debt. Now cost bondholders money to hold the instance of paying them. Central banks bought $10 trillion in bonds to help asset prices there. So there's a lot of that going on out there. When you say an equilibrium at 0% around a big balance sheet, it's very hard to change that, no doubt about it. So some of the problems that arise here, leverage has shifted to companies, was a result of U.S. households feasting on a cheap credit to buy homes. The loans weren't cheap because the interest rates were low. In fact, they were high compared to today. Why was I doing that? Anyway, many mortgages were made with low introductory rates. Yeah, they were low introductory rates. But that was just the introductory of these Ponzi-like conditions. They didn't have a Ponzi. The great scheme caused harm in housing, no doubt. It's sort of like credit card companies will offer a low interest rate, and then, of course, it pops up. The percentage of households used to make debt payments is now at a 40% low, but consumer deleverage companies bought, and some use debt proceeds to repurchase their own stock, and that's part of the problem here. The average debt to capital ratio for non-financial companies in the S&P 500 has surged to 49% by the end of June from 32% in 2006. So we're just getting us some our shadow banking friends. The subprime machine that led to a crisis was actually built in generating distributing models where big banks like Lehman finance third-party mortgage lenders own them outright. This is the shadow banking. People, when buyers for securities grew scared, but the originator factory kept humming along, filling the bank's balance sheets. And they passed it on to the shadow banking people, whether they owned it or not. One of the big problems out there. This is a very long article. I'll go ahead and append this. Let's go to the stocks. We'll just use Bloomberg today since we have it here. The Nikkei, let's see what the change was, 0.12% was the change at the Nikkei. The topics at 1.9%, the Hang Seng in Hong Kong at 1. Actually, we want to give the percentages here. Well, the 1 year percentage. And let's see, what else do we have here? We'll go to the BBC and round this out. The European, the FTSE 100 at 3.37. That's a 1 month there. We'll do it that way. The DAC at 0.71. And the calc, that's in France, incidentally, at 0.14%. And in Spain, a negative 0.55% there. And the Dow at 1.1 at 17.40. And let's see, what else do we have here? We'll leave it at that from Bloomberg. Bloomberg's actually better for doing the commodities. The Bloomberg Commodity Index, let's see, a negative 0.31 for their index. The Reuters Jeffers also at negative 4.45. And energy, Brent crude, we've been talking about it. Let's see, what are we set on it? This is West Texas. Let's get Brent crude in here. It was actually down 9 cents at $78.09. West Texas was up 46 cents at $68.99. T-Boone Pickens is still jumping for joy there. The gasoline index was down 2.27. Natural gas was down 5 cents, and home heating oil was down $1.43. Gold was down $7.10 at $1,201.10. The spot was down $6.62 at $1,194.85. Silver was down 10 cents at $14.04, and that's we don't. Cotton was up 32 cents. Live cattle, we haven't found out pork bellies yet, but anyway, is at $2.05. It was up $2.05. So that's some of the things going on here. Let me just go to the BBC while I just check some things out here. We started using, actually, the Wall Street Journal, a better determinant of what is going on. I think we did the FTSE, but just to make sure, this is the FTSE 100 at 0.31. That's a change, a percentage point there. The calc, I think we got it at 0.46. The DAC at 0.57. The Eurostat at 0.33. In Spain, they were at 0.39. I think we got the Dow right at 0.03%. That was a change, and the Nasdaq, excuse me, at 0.05 in the negative, and in Chicago at 0.3. The Hang Seng was at 1.01. The Nikkei at 1.20. Make sure we get everything right here. In Bombay, they were at 0.99%. That was the change in Asia. And we did that. They sort of looped these around a bit, so I think we got everybody in Spain, the UK with the FTSE. FTSE 260, don't usually give it, but anyway, it was the change there was 0.65%. In Amsterdam, we didn't give them; they were at 0.19. We got the calc. We got the DAC in Frankfurt, excuse me. So we got all of these basically here, and we sort of did a roundup, and we'll come to an end. But for the consumer, keep your eye on the prize. That was an interesting statistic, incidentally, we brought up in terms of, what was it, 1983, 82, 84 dollars there, and actually what people make in terms of real wages, less taxes, etc., roughly about $10 an hour out of the average of $22 an hour. Tells a lot there. We'll continue to monitor the impact of Hurricane Florence, particularly on that sector there and in the southeast. And of course, Bank of America is located there in Charleston, North Carolina. So you have a number of things going on there. Disasters. Will disasters play an important impact in the future, in particularly national budgets that they have to come out of someplace? And we're having more and more of these tropical type of storms, hurricanes, etc. in the season starting now. We had it last time in Houston, and of course, the devastating effects in Puerto Rico, but still have not been taken care of there. The infrastructure very poorly maintained as infrastructure in many parts of the U.S. Now, in some instances where hurricanes come every year, every 2 or 3 years, they have to replace power lines as part of the power grid, and etc. So some of those areas are more up to date, and of course the housing has to be replaced, rebuilt, etc. And that will, of course, bring about some temporary construction type work already in the industry that is having problems with workers, and we'll be looking at that because it becomes a macro situation because of the impact upon the nation's economy. But at the same time, we also have the tariffs that will have a long-range impact. And we look at consumer debt, where it is, and the gas prices that will go up. If once the Iranians are out of the picture, or more or less out of the picture, will the OPEC nations and the Russian Federation, etc., will they be able to make that up? The answer there is no. They'll not be able to make everything up there. And most of them are pumping now at demand. Now, there was a sort of a collusion there to cut back some of the production to keep, to up the production to keep the prices low. But if it's already upped, many of them had near capacity. We didn't have the Baker Hughes numbers this week, but we will get those next week, hopefully. And we'll start looking at the rig count in the U.S. and basically where this energy situation is, because it does affect the consumer. So say a 20% or 30 cent price in petrol or gasoline has an effect on consumer discretionary spending. And we're talking about in September, in October, before actually the holiday season comes in. Traditionally, August would have been the back-to-school type situation. We didn't see anything really in it, any movement there, but we have a different economy with all the online retailers, etc., that are out there. So in other words, things are different. And look at energy costs, etc. In parts of the U.S. today on the 15th, believe it or not, we have 90-plus degree temperatures, particularly in the Midwest. And those storms in the hurricanes, actually, tropical storms now, rain in the southeast, and some of those conditions will be moving. I I noticed from various baseball games, the Baltimore, Washington, D.C. area had been getting a lot of rain lately. This will do it for us. Actually, Consumers' Eye is on the ball. For those in business, make it a productive one. We did the Manufacturers Association and also the small business people. A lot of optimism in the small business sector at this point in time. We'll see where that goes, particularly as this starts to air out. Many of these numbers are not as great as they are promoted to be. They're a little better because Q2 was a little better at 4.1, dropping maybe 1% to 3%. But the problem is the outlining years as we go into Q4 and 2019 and 2020, 2021, etc. Because of demographics and other kinds of problems, you're going to start seeing GNP fall below 3%, back to its norm for the last, say, 10 years, more or less. So those are some things that will occur. And where will the deficit be? Well, supposedly at the end of September, the budget should be taken, or actually the nation's spending limit should be taken care of. They're going to have to do something with it and perhaps kick it over past the November elections. That probably will be what they will do. But one has to think about this. The GOP was talking about making some of the tax cuts permanent. The problem there is your deficit is going up, and away. And as you have more quote-unquote natural disasters, that also brings the budget out of line. So those are some things to look at. This, in our opinion, at this mic, much of what is going on right now in terms of tax cuts, in terms of other policies, are very short term. And when we say short term, we're talking about 3 to 5 years. And you'll see a totally different result appearing. And you're starting to see it right now as although wages are going up a little bit, but not very much at all in terms of the real wage situation. Have a good week and good day.